Okay, now sales tax payable. So it is levied on retail sales. So it is collected from the customer and remitted to the state. So we have illustration here that the sales at Home Depot totals 200,000, all in cash. Good stuff. So Home Depot collected an additional 5% of sales tax, which is 10,000, and the store would record that day's sales as follows. Right? So at the end of the day, they have sales of 200,000, right? So how they're gonna record the entry? Entry would be that cash received on the top of sales. So cash totaled to 210,000, and to sales revenue 200,000, and this 10,000 belonged to Home Depot? No, it belongs to state. Then we create a liability that is sales tax payable. Right? This illustration is easy. Why? Because we are given that you have collected additional 5%. Sometimes in the sale it is included in this 200,000. Tax is inclusive, right? Then you will find out, or you can say that you have to divide it 200,000 divided by 1.1. That would be your sales revenue, and the rest of the amount would be your tax payable, right? Okay. So accrued liability, what does it mean? It means liability occurred and you did not pay yet, right? So normally the accrued liabilities categories are wages payable, salaries payable, interest payable, income tax payable. You can have these separate account, or you can include all these into one account, that is accrued liabilities. So how we're gonna, it is easy, we already learned in our journal entries the same way they are treated. Payroll liabilities, it is specially set up for employee compensation. Major expense of the most companies are, for manufacturing companies, or biggest companies, their major expenses are employee compensation. So that's why they need this extra payroll liability account to see how much expenses they have to pay, and it can also be used in decision making, how many employees to hire, fire, plan for future, for retirement, pension, etc. So the payroll expense can be salary, wages, commission, bonuses as well. And the treatment of this we already studied, but we have an example here. So accounting for all form of compensation follow a pattern, and it's in your book exhibit 9.1. So when the salary occurred, you create a salary expense to salary payable, right? But salary payable is different than salary expense. How? Because if a person's salary is 1,000 or 10,000, you don't pay him 10,000 exactly. You cut some taxes, right? Some pension or some the requirement stuff, and for every country it is different. For example, pension fund, EP fund, GP fund, gratuity fund, whatsoever, and then at the end you pay him 8,000. So this 2,000 is the other stuff, and the payment is 8,000, which is other than the salary expense, right? So if you have work in China or somewhere else, you know better that your written salary is different, and when you receive the net salary, it is different one, and your salary tax is deductible, and some social security benefits, blah blah blah. So if we assume the figures, the entry would be salary expense to all kind of taxes payable, right? And this taxes is not you have to pay to the state. So that's why taxes payable, which is 1200. All the figures are here assumed. So don't just focus, or don't just confuse it where this 10,000 came from, where this 1200 came from. Okay, it is just sorry, assumption. So pay focus or close attention to the entry here. Salary expense to tax payable to FICA tax payable, and that is other pension payable or something, and then the salary payable, right? So your net salary is 8,000 that you have, you will receive, but since you did not receive it, so that's why it is a liability. So normally salary expense is not equal to salary payable. The logic I just explained it to you. So salary expense, it is represented as a gross pay. So create several payroll liabilities, employee tax payable, FICA tax payable, and salary payable. So company must also pay employer payroll taxes. So it is the responsibility in some countries, it is the responsibility of the company to deduct the tax and submit to the state. Rather, you give the full salary to the employee and assume that the employee himself, pay the taxes to the government. Unearned revenue, which means you receive the amount but you did not perform the revenue. It means you receive the sales amount in advance, simply. So business receive cash before actually earning revenue. So in that case, you cannot claim, the claim this as a sales, because you did not deliver the goods, or you did not, or the possession or ownership of the goods are not transferred to the customer. So in that case, the accounting says, you have to follow matching principle, and according to matching principle, we call this unearned revenue. So we create liability. So is the illustration. Just pause the video and read it. So when you receive the unearned revenue, or you receive the amount, and you have to perform services, or you have to send goods later on, then there are going to be two entries needed. One entry is when you receive the cash, and one entry when you deliver the goods. So when you receive the cash in advance, so in this case a ticket, the entry would be that cash to unearned revenue, or air traffic liability, right? 300. And then when you basically record it, and then unearned revenue to revenue, which is air traffic liability to ticket revenue. Now this is the sales, right? But since it's a round trip, right, and you issued only one side, so that's why it is 150, right? Okay. So when the other trip back to to the where you have to reach the destination, and destination to the home country, again 150 entry you will record it there as well, right? 150. So here is the illustration here. Just pause the video and try to solve this by yourself and match the answer accordingly. The answer, right? So where this subscription came from, here is the solution here. You can just read, revisit the question again, and then compare it, the solution here. Okay.